What if I told you that the biggest mistake investors are about to make in 2026 is not buying too high, but selling too early? What if this rally in gold and silver is not the top, not the peak, not the mania phase, but only the beginning of something much bigger? Right now, as we close out February and move 2 full months into 2026, the numbers are not just strong, they are historic. And here on Gold Silver Scope, we focus on facts, trends, and long-term shifts, not emotions. Let's start with where we stand today. Gold has just printed the highest weekly and monthly close in history. That alone is a major signal. After a year like 2025, where gold delivered one of its strongest annual gains since 1979, many people believed 2026 would cool down. They assumed we already saw the big move. But instead of slowing down, gold is accelerating. Even after a sharp correction earlier in the year, when prices dropped from around 5,500 to 4,800, the market absorbed the selling pressure and came back stronger. That is not weakness. That is structural strength. Now gold is trading above 5,200 again, pushing toward previous highs. In just 2 months, gold is already up more than 21% this year. That is roughly 10% per month. If that pace continued, and I am not saying it will, gold would more than double this year alone. Even if returns slow down, the trajectory is powerful. This is not random price movement. This is capital rotation. Silver is even more explosive. Trading solidly above $90, silver has nearly tripled from where this rally began around the $30 level a year ago. Yes, prices briefly touched 120 before pulling back. But do not focus on that temporary spike. Focus on the trend. Silver is up nearly 30% in just the first 2 months of the year. That kind of performance tells us something important. Silver is not lagging anymore. It is participating aggressively. Now let's talk about mining stocks because this is where many investors are still asleep. The major gold mining index, represented by GDX, is already at an all-time high. The Junior Miners Index, GDXJ, is also strongly higher this year. Both indexes are up more than 30% in just 2 months. Historically, mining stocks often move ahead of the metals themselves. And that is exactly what we are seeing. Mining stocks broke to new highs before gold and silver reclaimed their previous record levels. But here is the key point. Despite strong gains, there is no mania. There are no 20% daily surges. There are no emotional buying frenzies. Most days, these stocks move 1%, 2%, maybe 3%. It is steady, controlled, almost cautious. That tells me something very important. Investors are still skeptical. They are still afraid gold could crash. That means we are early, not late. When markets top, everyone is excited. Headlines scream about easy money. Taxi drivers talk about it. Social media explodes. We do not see that here. Instead, we see quiet accumulation. That is how long-term bull markets begin, not how they end. Another major shift is happening in the background. Global capital flows. Central banks have been reducing reliance on the US dollar for years. They have been steadily increasing gold reserves. This de-dollarization trend is not political noise. It is financial strategy. Nations want protection from currency risk, inflation risk, and geopolitical risk. Gold provides that stability. But what is different now is not just central banks. For years, Western private investors were net sellers of gold. ETFs saw redemptions. American investors preferred tech stocks, crypto, and growth assets. Gold was considered boring. That mindset is starting to change. 2026 may mark the first true year where private investors in the US and Western Europe begin allocating serious capital back into gold and silver. This is critical. When central banks buy, that supports price. When private investors buy, that creates acceleration. We are moving from the first phase into the second phase, and that is when bull markets become powerful. There is also a technological evolution happening. Gold is being integrated into blockchain systems and digital finance infrastructure. Institutions are beginning to embrace tokenized gold products. This bridges traditional hard assets with modern financial systems. Instead of competing with digital innovation, gold is becoming part of it. That removes a major psychological barrier for younger investors who prefer digital platforms. So step back and look at the full picture. Record monthly closes. Strong year-to-date performance. Mining stocks leading. Central bank accumulation. Western investor participation just beginning. Institutional adoption expanding. And still no mania. That combination does not signal the end of a rally. It signals the early stages of a long structural shift. And as we move into March, the bigger question is not whether gold can retest previous highs. The real question is how investors will react when it does, and whether they are positioned before that happens. This is not about chasing price. This is about understanding a macro transition that has been building quietly for years and is now accelerating in plain sight. Now let's go deeper into what may be the most misunderstood opportunity in this entire cycle: mining stocks and the global shift out of US dollar assets. Even though gold is trading near record highs and silver has more than tripled from its starting point, many mining companies are still valued as if gold were far lower. This disconnect is important. When gold rises, mining companies do not just benefit from higher prices. Their profit margins expand dramatically. If a company can produce gold at $1,500 per ounce and gold is selling at $5,200, the margin is massive. When gold was at $2,000, margins were solid. But at current levels, free cash flow potential is on another level. And yet, we are not seeing extreme valuations. We are not seeing speculative bubbles in mining shares. We are not seeing retail traders flooding into junior exploration names blindly. What we are seeing is steady, controlled accumulation. That tells us institutions are positioning carefully, not emotionally. Historically, the biggest gains in precious metals cycles often come from mining equities, not just the metals themselves. Physical gold preserves wealth. Mining stocks multiply it during strong bull phases. If gold revisits 5,500 and silver climbs back toward 120, which is very possible this year, mining earnings projections will have to be revised higher again. That repricing can happen quickly. Right now, many investors are still anchored to old price expectations. They remember gold at 1,800. They remember silver at 25. They cannot mentally adjust to a world where gold above 5,000 is normal. But markets do not care about emotional anchors. Markets adjust to liquidity, currency strength, and capital flows. And this brings us to the larger structural shift happening globally. For over a decade, U.S. stocks, especially technology, dominated global capital flows. Money from around the world poured into U.S. equities because they were outperforming. It did not matter that valuations were stretched. It did not matter that price-to-earnings ratios were historically high. As long as money kept flowing in, prices kept rising. But capital flows are changing direction. When money begins leaving an overvalued asset class, the impact can be slow at first, then sudden. We are starting to see pressure in major technology names. The artificial intelligence hype cycle, which drove massive gains, is losing momentum. When speculative enthusiasm fades, investors look for stability. They look for real assets. They look for cash flow and value. That is exactly where gold, silver, and dividend-paying foreign stocks come in. This is not just a metal story. It is a currency story. Central banks reducing dollar reserves is not a short-term trade. It is a strategic repositioning. Countries want diversification away from dollar dependency. That means increasing exposure to gold and other tangible reserves. Private investors are likely to follow. When they realize that holding cash in depreciating currencies reduces purchasing power, they begin searching for alternatives. Gold becomes attractive not because it is exciting, but because it is reliable. The most important thing to understand is that we have not yet seen Western retail panic buying. We have not seen aggressive gold allocation mandates from every major pension fund. We have not seen media headlines declaring gold as the only safe investment. Those things typically happen much later in a cycle. Right now, we are in transition. There is another psychological factor at play. Many investors are afraid of buying after strong moves. They think, it has already gone up too much. But price alone does not define value. If earnings power of mining companies is increasing faster than share prices, then valuation can actually become cheaper even as price rises. That is what many people miss. A mining stock that was expensive at gold 2,000 could be cheap at gold 5,200 if future profits are dramatically higher. Markets eventually price in that reality. When they do, repricing can be sharp. Also consider diversification. Investors who were heavily concentrated in U.S. assets are now reconsidering global exposure. European utilities, energy companies, and emerging market equities that were ignored for years are suddenly attracting capital. This shift away from U.S.-only exposure strengthens the case for precious metals because it reflects declining confidence in a single dominant currency system. This is not about predicting a dramatic collapse tomorrow. It is about recognizing gradual but powerful reallocation. When trillions of dollars slowly reposition, even small percentage shifts create massive flows into alternative assets. And remember, gold markets are much smaller than global bond or equity markets. It does not take a huge shift in global capital to move gold significantly higher. The same applies to silver, which has an even smaller market size and both monetary and industrial demand. When investment demand rises while industrial demand remains firm, price pressure can become intense. We are seeing early signs of that dynamic. So the key takeaway here is simple. This is not a random rally. It is part of a broader macro transition involving currency confidence, global diversification, institutional acceptance, and changing investor psychology. Now let's talk about positioning, risk, and one of the biggest debates happening right now, gold and silver versus crypto and speculative tech. When markets shift, they do not announce it loudly at first. They rotate quietly. Money leaves one sector slowly, then begins flowing steadily into another. We are starting to see that rotation. When tech stocks struggle, when high-growth names lose momentum, where is the capital going? It is moving toward tangible assets, toward cash flow, toward real value. Gold and silver are not just commodities. They are monetary metals. They have survived every financial system in history. They do not depend on earnings reports, software upgrades, or hype cycles. They depend on trust. And when trust in paper systems weakens, precious metals strengthen. Right now, some investors are still heavily exposed to speculative assets. Crypto markets, for example, experienced massive upside over the past few years. But the key question serious investors should ask is not, how high did it go? The better question is, what is the underlying value? Assets without intrinsic cash flow or tangible backing can rise quickly, but they can also fall quickly when sentiment shifts. In contrast, gold does not promise innovation. It promises stability. Silver does not promise disruption. It offers monetary history and industrial demand. That difference becomes very important during uncertain times. Another key factor is volatility. Crypto and high-growth tech can drop 30, 40, even 60% in short periods. Gold corrections are usually measured and absorbed. Even when gold pulled back sharply earlier this year, buyers stepped in. That behavior shows underlying demand, not speculative excess. This does not mean investors should panic or make emotional decisions. Smart positioning is about balance and preparation. The biggest mistake in a long-term bull market is selling too early because you think you have made enough. Many investors sell after doubling their money, only to watch assets go up 5 times more over the next few years. Patience is powerful in structural trends. At the same time, discipline matters. Investors should avoid leverage they cannot handle. They should avoid chasing spikes. They should focus on quality assets, strong producers, well-managed miners, and physical holdings where appropriate. Long-term success in precious metals is not about excitement. It is about conviction and time. We are potentially in year one of a broader Western participation phase in gold and silver. Central banks have already been accumulating. Institutional adoption is increasing. Blockchain integration is modernizing access. Mining margins are expanding. Capital is rotating out of overvalued sectors. That combination does not appear at the end of a cycle. It appears near the beginning of a powerful one. But here is the most important mindset shift. Do not think in weeks. Think in years. If this macro transition continues, if dollar diversification accelerates, if private investors increase allocations, if mining earnings expand, then the current levels in gold and silver may look cheap in hindsight. Markets move in waves. Corrections will come. Pullbacks will test confidence. Headlines will create fear. But long-term trends are driven by fundamentals, not emotions. So what should investors focus on now? Accumulation with strategy. Diversification beyond a single currency. Reducing exposure to overextended speculative sectors. And maintaining a long-term view rather than reacting to short-term noise. This cycle may redefine portfolio construction for the next decade. Precious metals are not just a trade anymore. They are becoming a core allocation again. If you want clear, simple, and realistic analysis about gold and silver without hype or fear, make sure you stay connected with Gold Silver Scope. We break down the trends, the data, and the macro shifts so you can make informed decisions with confidence. And remember, this discussion is for educational purposes only. It is not financial advice. Every investor's situation is different, and you should always do your own research or consult a professional before making investment decisions. The real opportunity in this cycle will not belong to the fastest trader. It will belong to the most patient investor.